Going to move straight on to the business news today. Cole Stangler from a business desk is with us. Big story, in fact, in the business because he's starting with what's been called a landmark lawsuit from the US government. This is against Google, isn't it?
That's right, Stuart. We had been expecting it, but doesn't make it any less significant. The U.S. Justice Department is suing the tech giant, accusing it of dominating the market for internet searches and harming both consumers and competitors, calling Google, quote, a monopoly gatekeeper for the internet. The case focuses on the firm's search engine and closely tied search advertising services. The government accusing Google of not only dominating those markets, but also making deals to illegally undercut competitors, like the billions it pays Apple to make Google the default option on iPhones. The state aims to demonstrate both these things in court, market domination and undercutting of rivals. As a remedy, the Justice Department is seeking what it calls, quote, structural relief, could mean anything from fines all the way to a potential breakup of the firm. While the case is expected to take years to litigate, it'll likely be watched across the tech sector. Firms like Amazon and Facebook also coming under fire in recent years. Many consumer advocates say they, along with Google, have been running monopolies. Accusations the companies deny. They say they shouldn't be punished for their innovation.
One way of looking at it is that firms really do have power, and they use the power to entrench themselves and to keep out the rivals, and that hurts consumers. The other way of looking at it, which is the Google way, is to say the firms don't even have power. They're facing huge amounts of competition. Competition is a click away, and leave the firms alone to do what they do so well, which is innovation.
Now, this isn't the first time that Google has been accused of violating competition law. In recent years, the European Union has leveled multiple fines against Google for this. In 2017, the firm saw a 2.4 billion euro penalty over the promotion of its shopping service. The next year, it was fined over 4 billion euros for, quote, cementing its market position through the mobile operating system Android. While the most recent fine came after the EU said Google restricted rivals from displaying search ads. Tech giant has appealed each of these cases. Now let's take a look now at some of Wednesday's trading action. European markets just hovering around the flat line to start the day, as you can see there. It's amid uncertainty over whether the U.S. will actually approve that highly anticipated stimulus plan. The FTSE just down around 0.1%, losses slightly on the CAC 40 here in Paris, while the DAX in Frankfurt also just around the flat line. Major Asian indexes in slightly more positive territory. The Nikkei up around 0.3% there. Shares on the Hang Seng up almost around a full percent, with the Kospi also showing some gains.
Let's move on to something else. This is the World Economic Forum. They've got some pretty bold new projections about the future of work.
That's right, Stuart. In a new study, the think tank says that half of all work tasks will be performed by machines by 2025, all thanks to automation, with secretaries and administrative assistants among those who may lose out the most. Still, the group's managing director says the long-term trend isn't necessarily a bad one. According to the report, new jobs will be created in fields like data, marketing, and robotics. Take a listen.
That doesn't mean that new jobs won't emerge, and they will certainly be emerging from all that we are able to find in the data. There are new tasks that can only be done by humans. There are new skills that people will need to be able to get there. So there's still a lot of work to be done, but the overall outlook for the future is still positive for people.
Yeah, perhaps though, of course, the biggest factor for job losses today isn't so much automation, it's the coronavirus crisis. It's really hurt sectors like aviation especially hard, isn't it, Cole?
Certain employees at Hong Kong's Cathay Pacific among the latest to be affected. The airline is planning to cut 8,500 jobs. That's about a quarter of its current workforce. The restructuring will also see the closure of the carrier's short-haul subsidiary, Cathay Dragon, with the firm pinning the blame on the pandemic and ensuing drop in travel. Cathay had received a 4.2 billion euro bailout earlier this year, but the company's CEO said the latest moves are necessary to survive.
Finally from Cole, Netflix. It's not growing quite as fast as analysts expected, is it?
That's right. According to its latest earnings, it added just over 2 million subscribers in the 3-month period ending in September. Now, that may be a lot, but it's just a fraction of the 28 million that have opened Netflix accounts this year alone. The company says the summer slump is due in large part to the spike that it saw earlier this year, as lockdown measures took effect across the world. Either way, it clearly left investors disappointed. Netflix shares fell over 5% in after-hours trading. Though, Stuart, it should be said the company continues to grow. It's about to hit 200 million subscribers worldwide.
200 million subscribers, that's massive, isn't it, Netflix? Thank you very much. Cole Stangler with